and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, and I'm joined today by a familiar face on Bondcast, our co-head of G10FX strategy, Brian Daingerfield. This week we'll be discussing where we're at in terms of the tariff back and forth in the headlines, a little bit about what Trump's view of Powell is and how we should be thinking about that going forwards, and then of course thinking about the DMO's remit revision in the UK and what we think about latest Bank of England speak. Let's start with tariffs though, because I think that's clearly what has been moving markets the most this week. Plenty of back and forth in the headlines again. Can you just give us, I guess, a bit of an update of where we are now, Brian, and what you think the likely path forward is from here over the next couple of weeks?
Sure. Thanks very much for having me, Imogen. So I think, what we have seen in the last couple of days is not specific de-escalation. There's some speculation in media that maybe auto parts could see some shifts in tariffs over the coming days to maybe have a bit of de-escalation specific to the auto industry. But as we record this on Thursday, we haven't seen anything concrete on that. It's been, reported in the FT and ABC and a couple of other media sources. But we've also heard from the president and from the Treasury Secretary some more conciliatory language as regards to tariffs and trade, and specifically with China, with Scott Bessent saying effectively a few days ago that the tariff levels in place right now are simply not sustainable, that he reportedly likened it to an embargo, essentially, that the tariff levels are so high that it's effectively making it uneconomical, a lot of that trade between the U.S. and China at current levels. And President Trump later sort of echoed this idea that tariff levels are very high and that they could come down substantially if there were to be a deal. And so I think the markets are seeing these signs of potential de-escalation and have certainly welcomed those acknowledgments. And I think it's pretty clear that Trump and his team are very focused on markets at the moment. And, the aftermath of the April 2nd Liberation Day tariff announcements, and specifically the sell-off in equities alongside the sell-off in the long end of the Treasury market, I think that sort of gave the Trump administration maybe a bit more appreciation for the potential risks to the financial system that come from these very rapid changes in policy. And I think what we have seen is the administration, has tried to think about and tried to signal to the markets that the announcements on April 2nd reflected effectively a cap on where the tariffs will go. And the markets, I think, generally speaking, have been eyeing the tariff picture, broadly speaking, with an almost optimistic feel to it, which is that the markets will enforce a softer trade stance overall. And, that's had fits and starts. That, I don't think that's been a universally accurate approach. We certainly feel like on April 2nd, the Trump administration went well beyond what, most would have expected if they were thinking the markets were going to force him into an easier stance. But I think it's pretty clear that they are focused on markets and on internal risks coming from tariffs. And so what we have seen is some signs that the administration is considering some targeted de-escalation here.
I guess you've sort of answered what would have been my follow-up question, but perhaps just to elaborate on that a little bit further is, what do you think drove the sort of potential for de-escalation this week? It was very obvious, as you say, when it came to the I think it was April 9th, after that April 2nd announcement day, that it was that combination of, fall in equity and then a rise in long end Treasury yields. And of course, markets have remained quite volatile, but we're a lot calmer than we were in those sort of that initial week following the tariff announcement. So what was it really that you think was the kicker for, the sort of potential for de-escalation this week?
Yeah, and I think, you're sort of alluding to it here, but, what we've seen is less maybe de-escalation and more just a pivot in the way that Trump and his team are talking about where we are in terms of tariffs, specifically with China, this idea that these tariffs are maybe unsustainable. That's not de-escalation in and of itself, but it is a change in the language from the Trump administration, both from the president himself and from some of the top leadership. And I think, there's an important difference to be made here between Trump and his team responding to internal pressures versus external pressures. So we think about this where a lot of governments are coming to the table and trying to negotiate with the Trump administration for more favorable tariff outcomes in response to the 90-day pause. But it seems like what we have seen, it seems to be a pattern growing where the Trump administration has been generally considering tariff de-escalation, product exclusions, delays based on internal stimuli rather than external ones. So rather than responding to the concessions being made by foreign governments, it seems like the Trump administration is taking a very internal focus. So the reason we've seen maybe pivots in language towards a softer approach is not because there's been a change in the steady state in terms of discussions with China. Instead, it's been more about concerns from U.S. businesses, concerns from consumers, concerns from CEOs. CEO confidence has fallen here in the U.S. Inflation expectations have moved up. And Trump himself acknowledged on April 9th that jittery markets were part of his calculus in terms of allowing for an extension. So I think it's important to make this distinction because it matters then what are the stimuli for de-escalation in order to understand what would it take to get more de-escalation. And this is a big question as relates to China, because we have felt that it would take a in-person meeting in particular between Presidents Trump and Xi to have a true de-escalation moment. But what the markets are maybe catching on to, or at least starting to entertain more, is that might not have to happen for Trump to allow for some targeted de-escalation if his concerns are all internal. Of course, the flip side to that, the concern is that for foreign governments looking to win concessions, it may be difficult for them to win concessions if the Trump administration is largely responding to internal pressures rather than external. So I think the concern would be, what is the incentive for the Chinese negotiators to come to the table with the president if the president is showing his desire for de-escalation is largely because of internal pressures rather than necessarily a reflection of what negotiators could bring to the table?
I guess thinking a little bit about de-escalation, but perhaps even just more broadly from a policy perspective, when you talk about Trump and his team, who do you think he is listening to most closely, or who should we be watching most closely when it comes to this kind of headline back and forth? Who do you think he's taking his cue from really within his camp?
Well, look, I mean, he has a lot of advisors who come from different backgrounds, who have different opinions on, the speed and strength of the trade of trade tensions, of escalation in trade. It seems like at the moment, because of the market stress that we have seen and the clear focus on markets, and particularly bond markets and the long end of the interest rate curve, and the upside in long end yields that we had seen, it seems like the Treasury Secretary is certainly getting, the Treasury Secretary is always an extremely important advisor, but he seems to be getting more attention from markets. And our sense is that his role as an advisor to Trump is maybe he has a little bit more credibility because of the volatility in markets that we have seen. That it's generally believed that among Trump's advisors that Bessent is among the less hawkish on trade, more in the camp of moving more methodical, moving slowly, phasing in tariffs over time. There was some speculation earlier this year that Bessent was angling for a tariff policy that phases in tariffs in stages rather than moves all at once, which was the ultimate result from the Liberation Day announcements. So we think it's right that markets are putting a lot of attention on Scott Bessent, the Treasury Secretary, who has been reportedly in this camp of a more methodical approach. And I think the fact that we've had this market volatility has maybe increased Bessent's role and increased his profile within Trump's camp.
Finally then, and perhaps following on a little from that previous question, of course, it feels like a lifetime ago now, but at the beginning of this week, or certainly at the end of last week, the debate had moved on a little bit from tariffs, and we were, of course, thinking about the future of Fed Chair Powell, amongst some comments that, Trump was unhappy with his recent interest rate decisions and might be looking to terminate, in Trump's words, his contract at the Fed ahead of the natural end date of his term, which is May 2026. Of course, we're recording this on Thursday, so since then Trump has been on the wire saying that he has no intention to fire Powell. But how are you thinking about Powell's future from here? And even if Trump has no intention to fire him, do you think he still has intention to perhaps limit Powell's influence on markets, perhaps via, appointing his successor early, for example, and forcing his hand in that way?
Yeah, I think it's important to start with Trump's seemingly his pivot on Tuesday, where He went from over the weekend talking about he could terminate Powell to on Tuesday taking a much less, sort of backing off from that stance. He's made those comments in the same press appearance when he talked about the China tariffs potentially substantially coming down if you get a deal. In both cases, that feels like it's a response to markets and a response to market concern about what could happen if Trump makes a move on Powell and threatens the independence of the Federal Reserve. So there's a couple of options available to Trump here. Some are more legally questionable because of the rules within the Federal Reserve Act, and that's specifically trying to fire Powell. And then there are others that are, leaving Powell to effectively close out his term on schedule in May 2026, as you mentioned. And then there's almost a middle ground option, which some at the administration may be entertaining, which is pre-selecting Powell's successor so that in the public eye, Powell's role is maybe reduced a little bit, that the market starts to take its cue from the next Fed chair who's basically been pre-announced. So maybe reducing Powell's relative importance, either relative to someone within the Fed board or relative to an outside successor, assuming that Powell would leave the Federal Reserve at the end of his term. So from the legal perspective, we're not lawyers here, but the general question that Trump faces for removing Powell is that the Federal Reserve Act states that the president can only remove the Fed chair for cause. And the idea of for cause termination is a legal standard in the U.S., which is generally believed to be for malfeasance, something like criminal activity, dereliction of duties, effectively. So rather than for policy disagreements, for something very specific, some very specific stimulus needed effectively to allow for the Federal Reserve chair to be fired by the president. Now, it's an open question over whether or not the sort of legal precedent underpinning this is something that will hold, because there's a court case going on currently about some independent members of other government institutions who Trump wants to relieve of their duties because of policy disagreements. And so there is potential for the legal backdrop surrounding the Federal Reserve and the for cause termination clause within the Federal Reserve Act. There's some room for the legal interpretation around that to maybe change. We don't really know the timing of that, but it is something that markets have to be mindful of. But the cost of making this move feels like it could be so monumental relative to the benefits. The benefit for Trump would be, okay, he gets a new Fed chair. Right now, there's no members of the Federal Reserve Board that currently, there's no openings on the Federal Reserve Board. So Trump would have to pick from within the Federal Reserve Board if he tries to demote Powell, for example. And it just doesn't feel like, if Trump is looking for someone who will aggressively cut rates, it doesn't feel like that person is currently at the Federal Reserve. And the way the Federal Reserve works is that individuals at the board have equal voting rights, essentially, the members of the board and also the Federal Reserve, the regional presidents. And so the role of the chair in that sense is not universal. The chair is obviously the most important person at the Fed, but it's not to say that a new Fed chair who has a very big difference from the rest of the Federal Reserve is necessarily going to lead the institution towards what Trump is ultimately looking for. And so the ramifications of losing independence of the central bank could be, among other things, a sharply weaker dollar, concerns about rising inflation expectations, feeding into these concerns about dollar and U.S. assets as a safe haven asset, store of value. And if you make this move on Powell now, it seems likely that this is going to be challenged in court. And that could be a worst case scenario for Trump in this regard, which is that Powell stays at the Fed while the legal questions are being worked out, and you're still dealing with the potential ramifications in the markets of Trump making a move on the independence of the Federal Reserve. So you take all of this together and say there's a much cheaper option for the president here, which is either to simply wait it out and to select the likely success or the successor to Powell as Fed chair sometime later this year. This is the shadow Fed chair option, and that Powell, staying in his term through May 2026, removes these questions about the independence of the Fed. Now, these questions about the Federal Reserve, the next chair of the Federal Reserve, and their relationship with the president, and Trump wanting to pick someone to run the Federal Reserve who has a different opinion necessarily, a different opinion about tariffs and trade policy, what it means for inflation, what it means for the ultimate policy rate. Those are questions the market will have to deal with because Trump will have an opportunity to pick the new Fed chair. Our contention is it's just a lot cheaper and a lot easier for that to happen in regular order to simply pick the next Fed chair on the regular schedule rather than trying to make a move sooner.
Okay, that all makes a lot of sense. Thank you.
So I think this is a great opportunity now to move into your world, Imogen, into the UK. So you mentioned it at the offset, but the DMO's gilt remit revision seems to be the big story of the week over in the UK. Can you walk us through some of your thoughts on that?
Yeah, sure. I guess just to give a bit of background for listeners that perhaps aren't familiar with this sort of remit revision process, and certainly for those listeners that are thinking, hold on, didn't we just have an updated gilt remit with the spring statement? Of course, that is correct. What happens with the timing of the spring statement being when it is, the OBR and the government, the Treasury, and therefore by extension the DMO, don't have the full year of public finance data for the fiscal year that's just been. There's still 2 months of data that are outstanding at the time when the OBR makes its projections for borrowing needs in the year ahead. So what we see every year is what we call a remit revision in the April, or once we have the full fiscal year's data for the year just gone. And it's usually only small tweaks, it's a couple months out of the full year that are being added to the borrowing revision, to the borrowing numbers that were announced in the spring. It's usually not a particularly market moving event. The DMO traditionally doesn't use it to change the way to change its issuance plans for the year ahead. It's sort of a couple billion here or there, and it's not something that we ever tend to pay too much attention to. This year it was slightly different, and different for two reasons. The first was that the borrowing numbers that we saw in February, after those numbers had been submitted for the spring statement, overshot quite considerably. So there was growing expectations that actually that CGNCR number that was published with the spring statement, the central government net cash requirement, was sort of already out of date, and it was already going to need to be revised up significantly, to the tune of around 10 billion, I would say, in this April remit revision. And the second reason it was getting a lot of attention was because, obviously since that end of March spring statement, the world has changed quite considerably. We've had very volatile markets, but in the UK in particular, the long end appears to have been quite vulnerable. We've had days in the UK where the long end of the curve has underperformed significantly, just like we've seen in the US with concerns around demand for dollar assets and the concerns around, foreign buyers showing up to auctions. There's been a renewed set of concerns, I would say, around who is going to buy long-dated gilts. And so there was growing speculation that the DMO would use this remit revision to kind of tweak its issuance plans further, to change the split of its issuance, where it was going to issue those gilts on the curve, which isn't what it normally does in April. It never usually departs from the bucket split that it published in the spring statement. So in the end, what we got was actually a much smaller remit revision in terms of the overall borrowing numbers than we were looking for. There was only a 5 billion upward revision to borrowing for this year. And the DMO has announced that it will be doing all of that via more T-bills rather than via more coupon issuance. So that was the first kind of bullish surprise, if you like, for markets, that we're probably looking for, as I say, a sort of 10 billion increase in the amount of gilts that they were expecting the DMO to need to borrow this year. But the bigger surprise, I would say, came with the shift in the bucket. So the DMO announces every year how much it's going to do in shorts, in mediums, and in longs. And I think most people were expecting them to tweak the long bucket slightly, to just shrink that amount of long issuance at the margin. But actually what we got was a much bigger revision to the longs bucket than we or consensus had been expecting. So that longs bucket now makes up only 10% of planned issuance this year. It's down from just over 13% at the spring statement. That makes a 10 billion kind of downward revision. So the bucket's gone from about 40 billion to about 30 billion, which in percentage terms is the smallest that the longs bucket has ever been. And to just put that into context, the longs bucket, even compared to last year, has shrunk by about half. It's gone from about 20% to 10% of overall issuance. So I think that it's important not to underestimate how much of a step change this announcement was for the DMO. Traditionally, like I say, they don't use that April remit revision to make big changes to the bucket. And that's partly because they have previously placed, in our view, a lot of value in the predictability of their operating rhythm. So they don't make big in-year revisions to their issuance plans by bucket, because that predictability has been traditionally very valuable, and they've, in some cases valued that predictability over the ability to be a bit more flexible and respond to changing market conditions. And what we're seeing here, what we saw in the spring statement, but particularly what was sort of re-emphasized in this week's remit revision, is that predictability versus flexibility trade-off, I think, has shifted for the DMO. They're now placing much more weight on the ability to be flexible, to be more nimble, to respond to changing demand conditions, volatile market backdrops, over than this kind of predictability of their operating rhythm. So we saw the longs bucket cut considerably, and we saw another addition to the unallocated bucket, which again just gives them that bit more flexibility to upsize their issuance plans, wherever on the curve they should need to through the year. So what we saw as a result was, of course, the back end of the curve outperforming, and we saw a curve flattening. However, that flattening barely offset essentially the significant curve steepening that we saw just the day before. And so when we look at the UK curve as a whole, even this financial year, which we've only about 2 or 3 weeks into now, the UK curve is still steeper on the fiscal year. It's still a lot steeper than its peers. And we fielded lots of questions this week, why hasn't it flattened more? And what's our view going forwards of what the DMO might do in terms of long issuance? And whilst I said earlier that we shouldn't underestimate how much of a step change this is from the DMO, I think it's really important to acknowledge that it's very important from a signalling perspective. But from a flows perspective, when we think about still how much long dated issuance there is to come, that still leaves, I think, the longer end of the curve vulnerable to higher yields from here. They've cut the longs bucket from 40 billion to 30 billion. But that 30 billion is, still a lot of issuance. If we think about pre-COVID, long dated issuance in the UK probably averaged about 35 billion. So it's slightly less this year than it was pre-COVID, but we're talking about a very different demand backdrop in the UK to what we had pre-COVID. You had price insensitive buyers essentially at that part of the curve. You had the Bank of England and you had pension schemes buying significantly more than they are now. And so, whilst it's a very welcome development and certainly a step further than we'd have been expecting the DMO to go this week in terms of cutting that longs bucket, I think the market is right to still be somewhat wary of just how much issuance is still to come at that part of the curve. And the second point I would make as well is that it's important to remember that the remit revision that we got was only based on the borrowing numbers overshooting for last fiscal year. It doesn't account for any potential updates to CGNCR that might be required as a result of, an underlying deterioration in the public finances, as a result of potentially weaker growth projections now that we have more news on the tariff front, for example. And so, in a sense, the borrowing numbers that have been announced for the current fiscal year, although they were, that upward revision was smaller than we had been expecting, it's safe to assume, I think, that actually, again, they're already based on sort of out-of-date fiscal forecasts. And the OBR won't update their CGNCR projections until the autumn, probably late October, early November. But we think it's quite likely that we will be talking about, again, in the autumn, another kind of set of upward revisions to the borrowing numbers, both in the near term, but also throughout the forecast horizon. And so, although this was a welcome development, I don't think it changes our assessment of the kind of precarious nature of the UK's current fiscal backdrop. And that's why we still see, potentially some upward pressure in yields, not just at the long end of the curve, sort of across the curve, but specifically at the long end as this supply-demand imbalance, we think, at that part of the curve persists.
Yeah, I think that point is super interesting about this idea versus predictability versus flexibility in issuance, particularly on which segment of the curve. Because of course, as I think about Treasury here in the U.S. and the potential questions with Scott Bessent and the Treasury Secretary talking about wanting to reduce long end interest rates, we're certainly dealing with those questions here with new leadership at Treasury about whether or not the Treasury would consider taking maybe a more flexible approach rather than in moving away from this favoring predictability towards a more flexible or technical approach. So super interesting to hear that the UK has maybe done a little bit of that given these market conditions that we have been in. But I did want to ask you as well, maybe focusing more in on the front end of the curve and some of the interesting comments we have heard from the Bank of England this week. So we've had a lot of BOE speakers this week. What have you made of all of these comments here?
Yeah, we've had a lot of BOE speak, and they've sort of shied away from saying anything too specific, I would say, about the monetary policy outlook, not least because we're now encroaching on the forecast period, or the period in which they collect the data for the monetary policy report, which is coming in a couple of weeks' time. But maybe 2 points that I would just make in terms of BOE speak that we've had this week. The first is that I think very marginally we're starting to see perhaps an acknowledgement of the downside risks to inflation from recent announcements on the tariff front. We had Megan Green, who arguably is one of, if not the most hawkish member on the BOE currently, whilst she still kind of retained her hawkish stance, and she talked about supply side issues that were likely to be inflationary rather than disinflationary. She did acknowledge that the two developments that really we've had since the last BOE meeting in terms of tariff policy and in terms of a weaker dollar are both inflationary for the UK. And so she seemed to be acknowledging more the kind of two-sided risks around inflation than she had done previously. She still used that cautious language, which in BOE speak is the more hawkish version of the careful rhetoric, although I think, as we've said on this podcast before, it's somewhat difficult to decipher the difference between the meaning of careful and cautious. But nonetheless, that is, the way that the BOE defines the difference, is that cautious is a little bit more hawkish. So she still talked about that. She still talked about being concerned about the upside risk to inflation. But she did acknowledge that recent developments perhaps provided more disinflationary pressures than our starting point just a couple of weeks ago. And similarly, Governor Bailey, he was at the IIF speaking at a sort of fireside chat on Wednesday evening. And again, he acknowledged the downside risks to growth from tariffs. And, listeners will remember, I think we talked a couple of weeks ago about our changed Bank of England call as a result of the tariff policy announcements out of the US. And, we added in an extra rate cut. And the driver of that wasn't necessarily that we saw a weaker inflation outlook, but it was just that we saw a weaker growth outlook, and that would give the BOE a little bit more space to cut rates slightly more than we had thought previously. And so it feels like whilst pre-April 2nd, the MPC as a whole had kind of nudged in a slightly more hawkish direction. They seem to be slightly more concerned about the upside risks to inflation. Perhaps the news flow that we've had since then has just tempered that sort of hawkish shift a little bit, and at the margin we're sort of shifting back in a slightly more dovish direction, which we think supports that narrative, as I say, of maybe getting a slightly lower terminal rate in 2025 than we had thought pre-April 2nd. The other interesting point, and the final point I'd make around Bank of England speak this week, without wishing to overstate the possibility, I think, that we return to a world of QE. But it is notable that both Megan Green and Hugh Pill have talked this week around the merits of targeted QE. Back in 2022, the Bank of England did what they would call financial stability purchases at the long end of the curve, which was aimed at calming some of the market volatility that we saw during that bout of significantly higher yields in autumn of 2022. And both Pill and Green this week have kind of talked up the merits of that kind of targeted QE. Not necessarily this idea that we're going to return to full-scale bond purchases, but that in times of market volatility and potential market dysfunction, there is merit in thinking about the options that the bank has on the table in terms of asset purchases. That stood out to me, not least because they're still doing quantitative tightening. So to shift towards buying bonds again, implies that they might be thinking about what the path ahead for quantitative tightening looks like. But also because, interestingly, they have created a lot of tools within their toolkit over the last couple of years since 2022 that I think, my view was, and they've sort of said themselves, were designed to be first line of defense, if you like, that would mean that, bond purchases, whether they're targeted or they call them financial stability QE or however they term them, but bond purchases could be a kind of last resort, and that wouldn't have to be their immediate policy response. And perhaps that narrative is just starting to change a little bit, that actually they think, well, hold on a second, bond purchases weren't such a bad idea. They didn't work so badly in 2022. We were able to buy bonds, calm the market, and actually sell them back at a profit compared to most of the QE bonds that they're selling back to the market now. And I wonder if there's just a very, at the margin, a kind of change or a shift in how BOE policymakers are thinking about the merits of QE going forwards. That's not to say I think it's on the near-term horizon, but it's just interesting to me that that's being brought to the fore as a discussion point. But perhaps that's enough on the BOE for this week. I know that we will come back to it next week ahead of the NPR the week after. So let's wrap it up here for this week. Thank you very much, Brian, for joining me. Thank you to our listeners for listening in. Just a reminder, if you liked today's episode, please don't forget to hit the like button and click subscribe so you can get the latest episodes as soon as they're available. Thanks. See you next week.